Okay, in this recording, I am going to cover Chapter 9, which is accounts receivable and accounts payable. Of course, you already know those names because we had those back in the early chapters. But this goes into a little bit more detail about those accounts. First, we'll talk about accounts receivable, and of course, that's where customers owe us money. And you can read through Chapter 9. They talk here about trade receivables. That's typically what's going on when a business is selling to a business are called trade receivables. One of the problems with companies who have a lot of accounts receivables is that not everyone's going to pay their bills. Now, I'm going to use the example of a credit card company like Capital One because they're here in Richmond. They're in the business of accounts receivable. All they do is issue credit cards and let people charge and try to collect the money from the customers who charged on their card. But they know, pretty much everybody knows that all those people are not going to pay their bill on time, or maybe they're not going to pay at all. So in accounting, we have to come up with a method for reporting that to people who might want to invest in Capital One. If Capital One just shows all of their receivables and doesn't show customers how many of those might be bad or might not pay, then they're overstating the case. They're overstating their receivables because they're never going to get that money. And if they don't get that money, then they have a cost associated with that. This book calls it uncollectible account expense, but really it's called bad debt expense. Companies in the business of financing realize that not everyone's going to pay. It could be Capital One, it could be a bank loaning money. Anybody who's in the business of just money, if that's their primary business, is going to have this issue. So what we're going to cover first in this chapter is how do you handle those accounts that aren't going to pay. By the way, let me stop and say that this chapter is going to be covered pretty quickly. We have so many chapters left to go that I think are more important that we're going to give this one kind of a broad brush. I don't expect you to learn a lot of technical stuff in this chapter, but there are certainly concepts that you need to know. Okay, the way if it's a large company that deals in receivables or in loan receivables, notes receivable, whatever, they have to have a way to let investors know what they think might not be collectible. And the way they do this is they call it an allowance account. And the entry is the company figures out what they think will not be collectible in the next year, the upcoming year, and they put it in, I would call it bad debt expense account. And they set up this allowance for uncollectible accounts, or sometimes called allowance for doubtful accounts. What you're doing, in essence, is setting up a pool of money. You don't know which customers aren't going to pay, but historically, you have numbers to show you that a certain number are not going to pay. So this is if you're in the finance business and you're setting up an allowance, this is the entry for doing that: debit, bad debt expense, credit allowance for uncollectible accounts. And this is how it shows on the balance sheet. You show your receivables at full value, in this case $100,000, less the ones you think won't be collectible of $4,000. So your net realizable value then is $96,000. Again, this is for investors to decide whether they want to invest in your company. If this number is 100 and this one is 60, they might say, no, that's way too risky for me. Okay. Now, companies can estimate how many accounts they think won't pay in a couple of different ways. First, they could do a percentage of sales. And they have enough statistical data historically to be able to come up with a pretty good number. So they would take their net credit sales, that is sales after returns and discounts, and multiply that by the historical percentage that they've experienced. In the case of percent of sales, they take that amount, in this case that they're showing you in the book, they're using 1% of 500,000, and so they're estimating their bad debt expense to be 5,000. they're adding that to their allowance account. Okay, if that allowance account has money in it from the previous year, so be it. Still add the new amount to the to that account. Okay. And here they're giving you an example of how this works out in terms of the T accounts. Okay. Now, the second method is called percentage of receivables method. And in that case, the company actually, let me go forward a couple pages. Here it is. They actually prepare an aging schedule. They look at each customer. They look at, is their balance due? Is it past due 1 to 30 days? If it's 1 to 30 days, you put it in that column. If it's past due 31 to 60, you put it in the second column, and etc. Now, they know that they know historically that of people who are not overdue yet, only 1% of those are going to fail to pay their bill. If it's gone into 1 to 30 day category, 5% are not going to pay their bills. And so on. 31 to 60, 10% won't pay. 61 to 90, 25% won't pay. If it's over 90 days, chances are 50% of those won't pay. So this is how they come up with the number of accounts receivable. Out of 828,000, they think 24.4 are likely to not pay. Okay, now, but this entry is a little bit different. In this one, they say, let's look at the example they give us here. They already have a balance in their allowance for uncollectible accounts. That means that their estimate last time was not perfect. When they do percentage of receivables, they are totally reanalyzing all of the accounts. In the percent of sales method, they are saying, look, we think the people who didn't pay last year in our estimates still aren't going to pay, and this is what we anticipate for the next year, so we're just going to add that in. Percent of receivables, they say, look, we're taking all of our accounts from last year and this year and reanalyzing them, and the number we come up with is what we want our allowance account to have in it. So in this case, they are saying, they want credit, they want $6,000 credit balance. That must have been on the previous page. Let's see, they want a, let me go back a little further, see where we are. Hoping they would give me an, you can see back here, this is on page, let me back up again because I've kind of skipped forward to show you that page about how they age their receivables. Okay, if a customer comes up with the fact that they want their ending balance to be $6,000, that's what they're telling you here. 6% of receivables will be uncollectible, and that's on $100,000. That's if they have no beginning balance. And that's the example here. They had nothing in the allowance account. They wanted it to be $6,000. So their adjustment is $6,000. So they're going to debit bad debt expense, credit the allowance. Second example, this is like year two. They already have a balance of $300 in their uncollectible account. They want their new balance to be $6,000. So their bad debt expense is only going to be $5,700, and they're going to credit the allowance account $5,700. What they're saying is we have taken these $300, we have reanalyzed those along with all the new ones, and we want our balance to be $6,000. This is the only thing complicated about the allowance for doubtful accounts, is that under the sales method, you add it to the balance in the allowance account. Under the percent of receivables, you bring their balance up to the new number they've calculated. So the memory tool I like to use is at and but. Okay, so you can see here, now if they had a $300 debit in the allowance account from the previous year, and they want their balance to be $6,000, they would have to put in $6,300. Just balance out your T account, and you'll see how that happens. Okay. The point is to remember here, there's a reason for the allowance for doubtful accounts, and that is to show potential investors or lenders like banks what the actual situation is with your receivables, that you're carrying them on the books, but they might not always be good. Now what happens when an account actually goes bad and you're using the allowance method? Think of the allowance method, which is a credit, as a big pool they've created. When an account goes bad, they put it against that pool. They start using up that pool they've created. So if an account actually is deemed to be bad, debit the allowance account because you've used up part of your allowance that you created, and credit accounts receivable to take it off the customer's books. Now, the company hopes that by the time all of these accounts happen during the year, that and their allowance account are going to kind of equal out. It's probably never exactly going to equal out, but you see the idea. So remember, you're taking it out of the allowance account that you have set up. You're using part of what you set up, taking it out of the customer's account. And remember, this is called the allowance method. Now, if somebody who says they think their account's bad and then they actually come back and pay it, this is what you would have to do in terms of entries. You'd have to put the receivable back on the books, put the amount back in the allowance account, basically reverse what you did, debit cash and credit accounts receivable like you would for a normal payment. I doubt that they have a whole lot of those happening actually. Okay, now let's talk next about credit cards. Credit cards, a lot of companies don't allow customers to charge. But many companies will receive credit cards. They don't care who the credit card's from. How you handle it is a little different depending on if it's American Express or Diners Club or Visa or MasterCard. Visa and MasterCard are the same as cash. These other companies like American Express and some of those, they don't give the companies back their money as soon as Visa and MasterCard. They have to wait a while. That's why a lot of businesses don't like to accept American Express and Diners Club. Okay, but if a customer comes in to your business and gives you a credit card, now in the case of these cards that don't pay you right away, you sell something for $1,400, the customer gives you a Diners Club. Diners Club is going to keep $70 of that, so that's called credit card expense. And from Diners Club, you've got a receivable of $1,330. You're going to receive that in the future, so you have to set it up as a receivable. Don't worry about what Diners Club does so much. Now, if you're using a regular Visa or MasterCard, it is considered the same thing as cash. You do a sale of $1,000. That night, when they do their nightly processing, you're going to get cash of $970, and they're going to hold back $30 for credit card expense. But that you don't set up as a receivable because it's going to come in right away. This is the majority of what you're going to experience. You're not going to experience a lot of that American Express and Diners Club. And again, that's a big reason why companies don't want to accept those cards, if you wondered about that. Okay, so in terms of accounts receivable, you need to know about the credit card, and you need to know about the two methods of calculating the allowance account and basically what goes on through those entries. Current liabilities, of course, accounts payable is the big one. Now, one item in here that we have not covered anywhere else is sales tax payable. I think I mentioned in some of my prior videos that in the beginning of the book, our company is a wholesaler. We're buying from a manufacturer, and we're selling to a retailer like Macy's. So the wholesaler doesn't charge us any tax, sales tax. We don't charge Macy's any sales tax because they're going to collect the tax from the ultimate buyer. Sales tax only gets collected from the last buyer in the chain. Now, if we happen to be the last buyer, the last seller, say we are, if we had a case where we are Macy's, then we're collecting the sales tax on that sale. So if a customer comes in and has a sale of $1,000, put that in at 1,000, we have to collect the sales tax of, in this case, 6%, $60, and that customer owes $1,060. It's our responsibility as the company to send that sales tax payable on to the state. This is for a whole period of time, not for just this one sale. In this one sale, we'd be sending on the $60, but they're telling you here that they collected $60,000 for the period, and they're sending that all on to the state. So remember that sales tax is only charged to the very last customer buying the product. No one in between has to pay sales tax, but if you're the final seller, you have to collect the sales tax, set it up in a payable account, make it part of the receivable, and then eventually at the end of the month or the quarter, you're going to send that on to your state agency. Okay, federal excise tax, we're not going to talk about that. If you stay in accounting, you'll get that in one of your tax classes. Current portion of long-term debt is not something I really think you have to know. I'm going to mention it just because a couple of you may be in accounting. I'm not sure. Those of you in business admin, you could care less about this. But every year when we have longer term debt that's not going to be paid for several years, every year, 1 year of that becomes current, right? Like it's like your house payment. You got a 30-year mortgage, but every year, 1 year of that is current because you got to pay it in that year. That's what they're talking about here is if a company has long-term debt, every year that some portion of that debt becomes current, they have to move it up to current liabilities. All of this stuff is done for analysis purposes so that investors and bankers can look at your balance sheet and see how much you have in current debt versus how much you have in current assets to pay those debts. So whether you'll be able to pay your current bills or not. Unfortunately, we don't have time in this class to go through financial analysis. It's just not enough time. The largest current liability is payroll. They don't cover that in this book. I'm okay with that. Those of you who are going to go into accounting will get a heavy dose of that in small business taxation. Those of you in business admin probably don't care. If you ever need to know, you can take a payroll class and catch up on that. But basically, it's like this. The employer puts the amount of your gross pay on the books as salary expense. They withhold federal income tax from you. They withhold state taxes from you. That's why these are all payables, because they have to send them on to the government entity. They withhold FICA taxes, that's Social Security and Medicare. If you're paying insurance premiums, they withhold that. And if they're not paying the payroll that day, they're paying the next day. They set it up as the salary payable. That is your net pay. Net pay. So this is the entry to record salary expense. I'm not going to have you calculate any of these. Just know that the employer has to withhold all these taxes. It's the law. And then at some point, they have to remit all of these things onto the government agency. Okay, salary payable is the same thing as your net pay. Salary expense is the gross pay. Now, the employer does have to pay 4 taxes. This goes into an entry called payroll tax expense. They have to match your FICA taxes. That is Social Security and Medicare. Whatever they withhold from you, the employer has to also pay that amount, so you get double. They have to pay state unemployment taxes, and they have to pay federal unemployment taxes. If you're to become unemployed and go for unemployment, that money is going to come out of the pool created by these 2 withholdings here. And again, the government's going to send the FICA taxes payable onto the federal government. State unemployment is going to go to the Virginia Employment Commission, and the federal taxes, unemployment taxes, go to the federal government. Now, the bulk of unemployment taxes go to the state because it's the state who pays unemployment. Federal sometimes, but mainly that's a function of the state. Okay, we're not going to cover product warranties in this class. I'm not going to cover contingent liabilities. All right, now, in the receivable and payable category, sometimes you have notes which are longer term than accounts receivable and accounts payable. What I want you to know from this section is how do you calculate interest? Okay. I don't like formulas very much, but if you just look at the information given to you, first of all, the rate, let's look at, to show how to calculate interest, assume a company borrowed $20,000 from a bank. The note had a principal face value of 20, an annual interest rate of 10%, and a life of 90 days. The interest calculation is, now that's based upon the formula. If you borrow money, $20,000, and the rate is 10%, that's the interest for the entire year. If you only borrow it for 90 days, then you have to multiply that by 90 over 360 because you only are going to have the money for 25% of the year. And that's how they come up with the interest. And make note that whenever you're calculating interest on notes receivable or notes payable, you use a 365-day year and a 30-day month. You don't use actual days in the month or actual days in the year, okay? Now let's go on to all right, there's an accounts receivable. Let me see what they have here next. Sometimes companies back up. In this case, a company has let a customer charge $18,000 worth of goods, and they put in accounts receivable. If this customer calls up and says, I can't possibly pay that in 30 days, but I can pay it in a longer time, the company may agree to take the accounts receivable off the books and make it a notes receivable, giving them longer time. In this case, they're giving them 3 months. Now, notes receivable and payable, you don't pay anything in the interim periods. You don't pay any interest. Everything gets paid off at the end. Okay. So in this case, they pay off the note receivable of $18,000. The company receives interest of $675, and it all comes in the form of cash of $18,675. Okay. On the other side, this was the seller side. This would be the buyer side. Buyer made a purchase for $18,000, and he came in and said, I can't pay that. The company let him change the accounts payable for a 90-day notes payable, so you swap those out. And then when the customer pays, he takes the entire notes payable off his books. He has interest expense of $675, and he pays cash of $18,675. So what they're doing is showing it to you from both the seller side and the buyer side. And the difference, of course, is receivable or payable. We're not going to cover dishonored notes or renewal of notes. Accruing of interest. If there's a note outstanding on your books at the end of the year and the company owes you some interest, they're not going to pay you till later because they don't have to pay until they pay the note off. You as a company, to abide by accrual accounting rules, should go ahead and put the interest on the books for what you've earned. Even though you haven't received it, they owe you that money. You should go ahead and put that on the books at the end of the year. Okay. All right. I think we've covered that pretty well. I will tell you that in some cases, companies won't do interest-bearing notes. They'll do discount notes. And what that means is if you ask a company to loan you $10,000, they might say, yes, but we're only going to give you $9,775. The difference is $225. That's the interest rate. When this customer pays this note off, he's going to pay off $10,000, but he only received $9,775 to begin with. I don't want you to know anything more about that except that's a discounted note. Discount means rather than set an interest rate, you just make it do a difference between what they're going to owe you in the future and the amount of cash you're going to give them now. This would mean getting into the time value of money tables, which is outside the purview of this course. Okay, we're not doing any financial results. Again, this is a short lecture because we're covering very little in this chapter. It's going to be, same thing's going to be true of chapters 10 and 11. We're going to go through those pretty quickly with minimal learning. Those of you in business admin will get enough to understand the terminology, and if you hear it, you'll know what people are talking about. Those of you moving on in accounting will be covering this information in depth in other classes, particularly in a tax class or in intermediate accounting. Because we have so much material to cover, we had to make a decision about what we could kind of go through quickly and still not leave anyone without the information they need. So that's the reason for the short video. I will, after this, go through the problems for Chapter 9 so that you will have those available. I would like this weekend to also get through Chapter 10 for you if I can. So I hope you have a good evening.